Alrighty, so firstly, thank you very much for taking the time out of your day. My name is Richard Jackson, CEO and founder of Jackson Capital. Thanks for joining us for the webinar on risk and correlation in your portfolio. Here we're going to discuss topics on investment portfolio construction and how a correlated matrix can help you in selecting your assets. This is a one-off webinar. I have done it before though, but this is probably the last time I'm going to do it, but it is going to be recorded. So if anybody who is missing it or want to see it again, we will have it recorded for you so we can send that out to you. I will try to also not be too technical with it, as there are some people in the room that don't quite understand, all of the different bits and pieces that we're going to be talking about, but I'll try and make it as general as possible. Okay, so as promised, in this webinar, I'm going to talk about correlation and risk. We're also going to discuss how qualified participants in the webinar can access hedging or our hedging strategies, so that in that I'm going to introduce you to the performance of our trading strategies, JCO5 and JCO7. Okay, so let's get started. All right. So for those who do not know us, Jackson Capital is a foreign exchange investment company based in Melbourne, Australia, and we specialise in quantitative research-driven approach to investing. The big takeaway here is that our company brings together a wide pool of people and skill sets, all of who are focused on the performance and management of your funds under management. For those who do know us, Jackson Capital has a number of proven traders and analysts from around the world who all contribute to ongoing development and trading of the currency market. Okay, so before I start, the reason why I'm conducting this, especially with more of our high net worth clients, is that quite often I have a conversation with our high net worth clients and ask them whether they're properly diversified in their portfolio. They say yes. However, they've usually got a lot of property, or they're overbalanced in property, or they've got an overweighting in shares or a managed or index tracking fund, which isn't really the way to go when you're trying to correctly diversify. And let me explain to you how this works. Investors sometimes are prone to playing favourite in their investment or investing in a single asset class like a low returning fixed income or Australian blue chip stocks, etc. By putting all of their eggs into one basket or one investment class, they're subject to what's called specific or sector risk. But don't be discouraged by this. It's a behavioural trait that we all have a bias to, and we tend to put everything into one asset class. If we know property very well, then we'll be property investors. If we know shares very well, or think we know shares very well, then we'll track shares, and we'll put it all in the one basket. Feeling comfortable with an asset class may be that you may understand well, like property, or investing in the status quo, or perhaps putting weight on short-term reactions rather than longer-term horizon, makes a portfolio subject to additional risk. So there are many risks and biases that face us when we're picking an investment, like investments like managed funds, ETFs, LICs. LICs, I mean by listed investment companies, stocks, property, bonds, etc. But there are two that are probably the most important. One is specific risk, and the other one is sector risk. And as you can see on the slide there, specific risk simply is a risk that affects a company or group of companies, which is subject to devaluation due to internal actions. And sector risk is risk that affects a sector or asset class, which is subject to external influences such as commodity prices, government regulations, or tidal waves. So we should also highlight another risk. It's called market risk or overall risk. This is where this is another component which brings investments under pressure. Market risk or systematic risk is the overall collapse of the market, such as in 2008. When the US banking system failed, everything else failed. It was just a systemic type of wipeout. This is where all sectors and assets have found themselves in struggling to be in the black. Now let's talk about the constituents of a typical portfolio. As mentioned before, there are many investments that can make up a portfolio, like managed fund, ETFs, LICs, stocks, property, etc. And at the beginning of our lives, we tend to focus on property, buy ourselves our own home, pay it off, and then we think about, moving into more other investments throughout our life stages. We place, discretionary funds into various other investments like another property, managed fund, or play the stock market. Some have even tried their hand at options or FX trading. However, a well-constructed portfolio should have a diversified range of assets. For example, in Burton G. Makel's book, Random Walk Down Wall Street, some of you might know it, he describes a great scenario of two investments. One company, I'm going to go through what this example is, okay? And this kind of illustrates it really well. One company is, and they make umbrellas, they manufacture umbrellas and they sell them. So you would expect them to do well when the season is raining and cold, okay? The other is a beach holiday resort, and you expect that company to do well when it's nice and sunny. If the season is warm, the resort will return 50%. And if it's raining, it will lose 25%. Conversely, if the season is raining, the umbrella company makes 50%. And if warm, it loses 25%. In the scenario, an investor can punt on the weather and experience a boom or bust. They get the 50% or they go bust, one of the two. However, Harry Markowitz, who is the pioneer of modern portfolio theory, suggests that diversification between the two companies can return a 12.5% return on either weather outcome. So we can dismiss what the weather is doing and diversify across both, okay? The key to this is to diversify in uncorrelated investments. Let's explain that a little bit further. Correlation is a statistic that measures the degree of which an asset moves in relation to another. This measurement is calculated on what's called a correlation coefficient, and it ranges between 1 and -1. 1 means it's positively correlated, 0 means it's uncorrelated, and -1 means it's negatively correlated. Okay, so if we take the original asset in blue here, we can see the blue line. If it moves in the same direction, like the orange line, which would mean that it's positively correlated. If it moves in the opposite direction, the grey line, compared to the blue line, is -1. -1. If it has no relation, or in other words, it has an equal mixture of positively correlated and negatively correlated moves, it comes out as uncorrelated, which is 0. Okay, so let's put this into the real world. take the below two investments. One is the Melbourne median house price between 2010 and 2016, and we're comparing it to SYI, which is an Australian Select High Dividend Yield Fund, which is just a popular index tracking ETF. The correlation coefficient between the two is negative 0.0466, which we can assume is almost zero, so they're uncorrelated. And these two will work well in a portfolio. If you've got some property and you've got this SYI fund, then these will work nicely. Okay, so if there is a problem in the property market, then the SYI fund would make up the difference, and vice versa. Building a correlation matrix of investments or asset classes can help an investor design a portfolio so not to stack correlated assets. This can be done by yourself by looking at the returns of the investment. Simply take the return of the investment for each year and compare it to the others. You can either do that as a cumulative type of thing, or you can just take the investment as it is. Here I've got five investments, XJO, Melbourne median house price, SYI, which is the one we spoke about before. We've got the JC7, managed discretionary account. We'll put that in there. And we've got Vanguard Australian Shares Index, which is the same sort of thing as SYI. It's an index tracking fund. So you can see here, XJO compared to the XJO, of course, they're correlated because we're talking about the same thing. But if we take the XJO and we compare it to JC7, okay, or SYI or even VAS, they are uncorrelated because they're almost zero, okay? And then what we can do is, instead of us building a portfolio with SYI, JC07 and VAS, where they're all stacked together as being similarly correlated, we can think about maybe putting some in property and reducing our weighting in the other three, okay? All right. So where's the sweet spot? Now we've learned that when considering an investment portfolio, risk and return are not the only elements to study, okay? The correlation between each of the investments is also required to protect against specific or sector risk. Because if you put everything in property and there's something happens with the property market, then you're going to go down with it. But if you've got uncorrelated assets within your portfolio, if something happens to one of those asset classes, then you won't be subject to the overall downturn or specific or sector risk. So we suggest looking for a correlation coefficient of between -2 and +0.4, sorry. -0.2 and +0.4. Got a bit excited there. Okay, so we also got to remember, and I did point this out just before, and write this down if you want to. Remember that correlation is only one part of choosing an investment asset. You'll also have to make sure that you're satisfied with the risk and return of that investment as well. Okay? Make sure that the risk and return is also inside your preferred range. So by now we should understand how to properly diversify a portfolio to help avoid specific and sector risk. But how about overall market risk or systematic risk? Okay. Remember that this type of risk usually gets everybody. The best example is the 2008 financial crisis, which affected the banking sector and the systemic fallout, which then provoked all other sectors. Let's talk about hedging. I'm not going to go on about this too much. Most of you, most of the people in the room are high net worth, so you should already know this. Hedge funds are typically made up to try and outperform the stock market. However, they've got high costs to them because they run with a performance fee and a management fee that goes along with it. And recently, because we've had good moves in the US stock market, simple index tracking funds are doing better. So there's been this big shift away from hedge funds and back into index tracking funds, which are cheaper to run. Is this going to last forever? No. As soon as the US stock market has a pullback, all of these long-only investors that are, jumping in right now are going to be suffering. Okay? We heard the one from Warren Buffett, be fearful when others are greedy and greedy when others are fearful. Okay? So I probably wouldn't be buying the US stock market at the moment, right? I'd be looking for a pullback or indication to just take shorts on it using derivatives. However, look at the returns as well. 6 months of the year, 2016, saw the industry-wide returns of hedge funds of just 1.09%. So if you're looking for a hedging type of mechanism to diversify your portfolio, a 1.09% return is probably not going to satisfy you, is it? So let's have a look at the new investment hedge. Okay. So hedge funds try and outperform the benchmark and invest in value areas. So it would be prudent to include such a hedging type of strategy into a portfolio. The problem is most hedge level funds are not usually available to all retail investors because they look for the big dollars. Additionally, the benchmark, I'm not sure that everybody realizes this, even if there's a loss and they still outperform the benchmark, they'll still claim their performance fees, right? So this is what everybody was a little bit upset about in 2008. Okay, so this is where Jackson Capital is a little bit different. We are a hedge level firm offering investors accessibility or an accessible hedging solution to plug into your investment portfolio to reduce financial risk and increase overall returns. And I'll go through what those returns are in just a second. So if you have a portfolio which includes property and a handful of blue chips, shares or ETFs, but you want to include a high-performing hedge so that you hedge against systematic risk and even sector risk and increase all your overall returns, this might be for you. Okay, I want to run two scenarios, okay? Two scenarios here. This is with actual data, all right? This is data from the market. We're running two scenarios assuming $1 million valuation in 2010. So Melbourne, say house price being 70% of your allocation, 70% of your portfolio. Jackson Capital being 10% of your portfolio. SYI fund, high dividend yield fund, 10%. And VAS, Vanguard Australian Shares at 10%. That's scenario one. Scenario two is exactly the same, but I've put the 10% of Jackson Capital with the VAS. So I've just moved the 10%, okay? I'm sure everybody can see that. Okay, move the 10% out of Jackson Capital and into VAS, okay? So let's have a look at what the outcome was. The blue one, the blue line is the cumulative chart with including the Jackson Capital MDA with just 10%, so 100 grand in it. And the orange one is without the Jackson Capital JCO7. So the difference is $219,974, almost $220,000. Okay. So you can see that high-performing hedging solution can safeguard against additional risk, but also increase the overall return. Okay, let's talk about the performance. Our products provide a new paradigm for investors to access sophisticated currency products without the incumbent knowledge, experience, time required to trade the complex, fast-moving market successfully. This good thing about this is because it's a managed discretionary account, you have the control, the flexibility, the transparency. You can watch our trades live. There's no redemption periods, there's no lock-in periods, there's no management fees. You have an experienced investment manager that trades the individually managed account on your behalf while you watch live. So you can see exactly everything that we're doing. If you don't have to, if you're not interested, don't watch it, but you can watch it and you can see how we trade. Okay, we recommend 5 to 10% of your portfolio allocated to this Jackson Capital MDA. Our target is net return in excess of 20% per annum, which we have achieved on average. Although there are, of course, there's no assurances that the MDA will meet the objective, but you can see from our past history that we have. We've got 2 strategies, and I encourage everyone to diversify between both of the strategies, so that you can get the full the smoothing of the equity of your equity curve. And what I mean by that is if one strategy is not quite performing or treading water at one point, then the other one will make up for it, and vice versa. All right, have a look at some of the performance here, okay? We've got verified and audited results, so you can actually, upon request, you can have a look at them for yourself. Let's just look at the year-to-dates and the breakdown on annualization. JCO5 has been running for about 2.5 years. We've been doing, the last year, had about 32.71%. Over the last 2 years, we've done 24.41%. And since inception, 120%. Low standard deviation of 5.15%, which standard deviation simply means the volatility in the equity curve, okay? JCO7's been doing a little bit better. In the past year, 46.74%. Last 3 years per annum, 31.63%. Last 5 years per annum, 38.18%. 637.22% since inception, and a little bit higher standard deviation of 9.16%. We charge a performance fee of 30% based on high watermark. We have no monthly subscription fees. We have no entry or exit fees. We have no redemption period, so you can enter or exit as you wish. We'll give us 24 hours notice. We'll have your money back to you. Okay, so I'm just about to wrap it up. If anybody's got any questions, please chat, or please go to the chat box and please type away your questions so that I can answer them. If you want to know more about it, you can talk to Michael. I'm sure most of you have already spoken to him. You can grab him on his email address right there, or you can call him on the phone number there. We're also recording this, so we will send out a recording of this so that you can have another listen to it and have another look at it if you wish. You can also see a lot of information on our website under articles. We've got information there about how we trade, our take on the market, etc. So I'm sure you guys have all gone to our website already, jacksoncapital.com.au or jacksoncapital.asia. Up to you guys, whichever one, they all go to the same spot. Hopefully you got something out of it, and hopefully we'll speak soon. Okay, thanks guys.